In this portion of the video, we are primarily concerned with discussing our strategy options. To recap, we've done our market data research, determined a dollars per square foot average for the particular neighborhood we're working, and within that neighborhood we've identified a lead, and based on entering our lead in our market data spreadsheet, we've determined that the approximate after repair value for this property is $129,000. We've done our on-site repair inspection using this repair inspection spreadsheet, and that has totaled up to $11,647.50. And now we're ready to do some strategy analysis to determine what our options are potentially with this property. Now, if we know that we would like to flip for quick cash, and the neighborhood is suitable for that purpose, as in, this is likely an investment property. Really, whether it's an investment property or a retail property doesn't necessarily matter. The key is going to be what the seller's asking and what his motivation is, because as you can see right here, the spreadsheet has automatically calculated 3 potential maximum allowable offers based on the 3 main categories of exit strategy. The first category being flip, an offer for a flip strategy, which is simply if I want to sell this property for quick cash at a quick profit to another investor, or potentially an owner-occupant, it's just that most of the time that is an investor, then this is what I can pay for the property if I want to make $10,000 gross profit. That's a standard wholesaler's profit number there, and if I change that amount, you'll notice that it would recalculate my maximum allowable offer. And of course, $50,000 is going to probably be too much in this case. Let's change that back to $10,000. And it gives us what we would have to pay for that property. So the question is now in my mind, okay, if I want to try to flip this thing for quick cash, is it possible for me to get the seller to accept an offer of $62,202? Because if that's not possible, then that may not be a workable strategy, because again, seller motivation is one of your fundamental issues that will impact your ability to get the deal. So let's say the seller is asking a lot more than $62,000 for this property. Maybe they're asking $80,000, $90,000, $100,000 for the property. So we could always make an offer of $62,000 as an opening offer and see what they would say. And if they accept it, then we know that we have the option to flip this property for cash. If they turn it down, then it may be more likely that we're not going to be able to get that deal. But nonetheless, this is what our target buy price would be in a scenario where we want to try to flip this property for quick cash. Next would be whether or not we think we might hold this property. And again, if you recall from the example used in the market data spreadsheet video, I stated that the particular makeup of the neighborhood was about 70 to 75% owner occupied and about 25 to 30% rentals. So it makes it a potential rental neighborhood, also potential retail or discounted retail. So I've got several options here depending on what kind of an offer the seller is willing to look at. If I want to hold the property for income purposes, the next thing I would want to do is determine what the income amount is likely to be in that neighborhood. So for purposes of our example here, let's just say that I've contacted some other landlords in the area or some other properties for rent, and just pretending to be a tenant, I've asked the owner, how much are you renting this property for? Or maybe I've looked in the classified ads in the paper to see what properties in that neighborhood are renting for, and perhaps I've asked a realtor that I've made friends with, can you pull me some comps on what things are renting for in this particular neighborhood? By whatever means I come up with that number, I want to put that number in here and just have it as a handy reference if I'm thinking about holding the property for cash flow. So let's just say for our example that this property would rent for approximately $1,000 a month. And by the way, it's very important that you verify these numbers. These are not to be loose assumptions. While your estimates in these spreadsheets are not guaranteed to be accurate to the right down to the penny, remember that their accuracy does depend on your ability to gather accurate information and not make assumptions. Don't let people tell you, especially the seller, do not take the seller's word for what a property will rent for. You need to verify this by finding out what other similar properties in that market are actually renting for currently. And then I've included over here the outline of the formula that you want to use to look at your cash flow. For example, let's say that I've calculated using the PITI calculator, which is in a separate section that follows this section. I've determined that my payment is going to be, including my taxes and insurance, I've determined that my payment is going to be $900 a month. So I would simply just plug in a formula and just add it, type it in based on the numbers I've gathered. So if the income that I'm showing is likely to be $1,000 a month, then I can type in 1,000 minus my $900 payment equals, and of course in this case 100. So now I'm looking at a potential positive cash flow on this property of $100 a month. That's not very exciting to me. I'd like to see at least 200. So then my options are, can I go back and get a lower offer on this house? If I offer the seller, say, $78,000 versus $88,000, will that put me into a situation where my cash flow is better? And you can refer to the video and the audio instruction rather on the PITI calculator to show you how to backwards engineer this to determine what your offer price should actually be in order to achieve a specific income goal. But this is put here for reference so that you can do a handy cash flow analysis and just see quickly, is this a viable option? But I would say that at this given price here, unless I can get the seller down a good bit more, it does not look like this property would be ideal for cash flow. Next would be a retail option, meaning retail being defined as selling to an owner-occupant at or near full price. So what it shows is I can pay more simply because if I'm selling to an owner-occupant for full price being my after-repair value of $129,000, then I can pay more for the property than I can if I need a quick cash sale. So my maximum allowable offer is substantially higher than an offer that I would use to wholesale the property. So at this price, I can now offer the seller this amount, and based on my after repair value, if I manage to sell the property for the after repair value, then this is the gross profit amount that I stand to make. So, by the way, these offer prices right here are based on standard formulas. You can reference these formulas in other sections of the manual. In the resource section, it explains how these formulas were structured and how they're generated. And if you want to change these formulas, you can do so by downloading the editable versions of these spreadsheets, which will allow you to change the formulas and use whatever percentages you would like to use. So just make a note that if you want to know how these formulas are being calculated, refer to the resources section for specific detail on the formulas that are included. So I'm looking at the three options I have here, and let's say that the seller is asking, we know the property is worth $129,000, but it needs a pretty good bit of repair work based on our estimate, and we know that the average dollars per square foot in the neighborhood is around $80, $82, $83 a square foot. So with that in mind, we're analyzing our potential offers, and the first thing we have to ask ourselves is, what is the seller asking versus what I can offer? For example, if the seller tells me that he won't take a dime less than $120,000 for this property, then chances are he's not that well motivated, so we may not be able to make a deal, because I cannot offer $120,000 on a property that's only worth $129,000. But if the seller says, you know what, I'm flexible, I've got to get out of here, I'm leaving town, whatever the case might be, I'm in debt, I'm in foreclosure, I've got to do something, just make me an offer. If I can offer him $91,000 and he'll accept it, then I know that I can potentially make a deal on this property if I feel good about my chances for retailing. I could also, if he'll take less, I could try reducing my property price, my offer price, and increasing my cash flow, and I might want to hold the property. Or if I know that the seller is willing to take a lower amount, such as this number here, which would facilitate a wholesale transaction, then I might prefer to just give him the lower offer and go ahead and try to flip the property to another investor quickly and make some quick cash. So motivation plays the biggest role right here. I can readily see what my offer prices are going to be for each of the particular strategies. And then it's up to me to combine a combination of seller motivation, the situation with this particular neighborhood. If I've done my research, I should have some kind of reasonably good idea of what I can do with this property, what's going on in the neighborhood, and what strategy probably makes the most sense. If the neighborhood is selling like hotcakes to owner-occupants, then obviously retailing is a good way to go. But if the neighborhood is more run down and is heavily populated with rental properties, then wholesaling would probably be the way to go. And of course, if my cash flow is good, then certainly I could look at holding for positive cash flow if I'm happy with the amount of cash flow that I can generate. So once you get these numbers in place, the next step is really to look at what you feel your best option is based on the market data research that you've done for that neighborhood and based on what you know about the activity in the neighborhood. Exit strategy choices are always somewhat subjective because of the fact that there are issues that vary. The level of seller motivation will vary. The level of activity in a neighborhood will vary. Whether the neighborhood is in excellent condition versus rundown condition. All of those things will play into your choice of exit strategy. The important rule of thumb to remember is that when you're making your offer, you want to match your exit strategy to the best characteristics for that neighborhood. So again, if that area is heavily populated with rundown rental properties, then probably your best choice is to flip that property to another investor for cash, or potentially hold it. If it's all rental properties, potentially hold it, but you would not want to try to retail in a rundown rental property occupied neighborhood. On the other hand, if it's an excellent neighborhood with excellent quality, then certainly retailing might be your best choice, where wholesaling might be nearly impossible because you simply would not be able to get the seller down to a price that low. So strategy choices really involve first running the numbers, analyzing that market, getting your repair numbers, and then looking at what your offer options are, and then comparing that to the condition of the neighborhood and the activity in the neighborhood to match up your best possible choice of neighborhood characteristics with the best fitting exit strategy for that particular neighborhood. This is something that takes a little time and experience to learn and get good at. But the one thing you don't want to do is make a total mismatch. For example, a big mistake that investors make is assuming that they will flip a property quickly for cash that's in a better neighborhood. You'll waste your time trying to make lowball offers on properties that are in very new, nice condition neighborhoods. And by the same token, buying a rundown fixer-upper in a rental property neighborhood with the intentions of selling it to an owner-occupant is also a big mistake, because owner-occupants will not buy houses to live in neighborhoods that are heavily populated with run-down fixer-upper properties. So it is important to match the characteristics of the neighborhood with the exit strategy that makes the most sense for that neighborhood.